In the year 2000, General Electric was the most valuable company on Earth, worth $600 billion. It had taken more than a century to build light bulbs, jet engines, power turbines, MRI machines. GE didn't just electrify America, it helped build modern industry itself. By 2021, it was worth less than $100 billion, and the board voted to break it into three separate companies. GE wasn't defeated by a competitor, it wasn't disrupted by new technology, it was dismantled from the inside. 2 decades of financial engineering quietly hollowed out one of the most admired corporations in American history. This is how a $600 billion empire was sold for parts. Thomas Edison founded GE's predecessor in 1878. By the mid-20th century, the company had become synonymous with American industrial power. It built the turbines that powered cities, the engines that moved aircraft, the imaging systems that transformed medicine. GE was one of the original 12 companies listed on the Dow Jones Industrial Average in 1896. For most of the 20th century, it didn't just participate in the American economy, it was the American economy. Then came Jack Welch. Welch became CEO in 1981 and immediately began reshaping GE in his image. He earned the nickname Neutron Jack. The buildings were still standing, but the people were gone. He eliminated over 100,000 jobs in his first 5 years. He introduced rank and yank. The bottom 10% of managers were fired every year, regardless of performance. But Welch's real transformation wasn't operational, it was financial. Under his leadership, GE Capital, the company's financial services arm, grew from a small lending operation into one of the largest financial institutions in the world. By the late 1990s, GE Capital generated more than half of GE's total earnings. The market loved it. GE's stock price rose over 4,000% during Welch's tenure. He was named Fortune's Manager of the Century. Every business school taught the GE model. But the model had a flaw that no one wanted to see. GE Capital's earnings were used to smooth the entire company's results, making GE look like a perfectly predictable industrial machine when it was increasingly a leveraged financial institution. The consistency wasn't discipline, it was engineering, the accounting kind, not the kind that built jet engines. When Welch retired in September 2001, GE was worth $600 billion. He left with a retirement package worth over $400 million. The company he left behind looked invincible. It was the most fragile it had ever been. Jeff Immelt took over on September 7, 2001. 4 days later, the towers fell. The attacks hit GE's insurance businesses immediately. Then the dot-com collapse eroded the stock further. Immelt inherited a company that had been optimized for one man's management style, and that man was gone. But Immelt's problems went deeper than timing. The earnings engine Welch had built required constant fuel, new acquisitions, new financial products, new ways to make the numbers work. Without Welch's credibility and the bull market to sustain it, the machine began to stall. Immelt's response was to bet big, again and again. In 2015, GE acquired Alstom's power division for approximately $10 billion. It was the largest deal in GE's history, a massive bet that global demand for gas turbines would keep growing. It didn't. The market for gas turbines peaked almost exactly when the deal closed. Renewable energy undercut gas power faster than anyone at GE had projected. Within 3 years, GE's power division had lost billions. The company took over $22 billion in write-downs. The Alstom deal became a case study in corporate overreach, a CEO doubling down on a thesis the market had already moved past. But Alstom wasn't Immelt's only misstep. He spent $16 billion on oil and gas acquisitions just before crude prices collapsed. He sold NBC Universal, one of GE's most valuable assets, to fund industrial deals that destroyed value. Over 16 years as CEO, GE's stock fell by more than 30%. The broader market tripled over the same period. Then came the crisis no one had budgeted for. In 2008, the global financial system seized, and GE Capital, the engine that had powered 2 decades of growth, nearly brought the entire company down. GE Capital held over $500 billion in assets, making it one of the largest financial institutions in the United States. But it wasn't regulated like a bank. It didn't hold reserves like a bank. When credit markets froze, GE couldn't roll over its commercial paper. The company was days from a liquidity crisis. Warren Buffett invested $3 billion on preferred terms. The federal government designated GE Capital as systemically important. The company that built jet engines needed a government backstop because it had become, without most people noticing, a shadow bank. By 2017, GE's stock had fallen below $20 for the first time since the financial crisis. The board replaced Immelt with John Flannery, who lasted 14 months before he was replaced by Larry Culp, the first outsider to lead GE in its history. Culp discovered the damage was worse than anyone had disclosed. GE's long-term care insurance portfolio needed $15 billion in additional reserves. The SEC opened an investigation into GE's accounting practices. The company had been managing earnings so aggressively for so long that unwinding the complexity took years. In June 2018, GE was removed from the Dow Jones Industrial Average. It had been a member for over 110 years, longer than any other company in the index. The removal was symbolic, but the symbolism was devastating. The company that once defined American industry no longer represented it. On November 9, 2021, GE announced it would split into 3 independent companies: GE Aerospace, GE Vernova, and GE Healthcare. The breakup was complete by early 2024. The company that Thomas Edison helped create, the company that had been synonymous with American industrial power for over a century, was sold for parts. Not to a rival, not to a foreign acquirer, by its own board to its own shareholders, because no one believed it could hold together anymore. General Electric is not a story about one bad CEO or one bad deal. It's a story about what happens when a company begins to value financial performance over operational excellence, and then compounds that choice for 20 years. Jack Welch didn't destroy GE. He built a machine that looked extraordinary from the outside and was unsustainable from within. Every successor inherited a structure that was a little more fragile, a little more dependent on the next deal, the next accounting adjustment, the next quarter's number. This is the template for the financialization of American industry. When the people running a company are rewarded for managing earnings rather than managing operations, the incentives compound. And by the time the gap between perception and reality becomes visible, it's too late to close it. GE was worth $600 billion because the market believed it was a perfectly managed industrial company. It was sold for parts because it was actually a leveraged financial institution wearing an industrial uniform. The buildings were still standing. The company inside them was already gone.